I hope you can hear me. My name is Sean van den Berg. I head up client education at PhD Online. Welcome to our webinar on candlesticks. From the turnout, it looks like it's very popular, and I hope you all enjoy it. Those of you joining us for the first time, this presentation will be sent out to all the participants, as well as the recording. So this presentation is being recorded, and any questions you might have, just type it up in the little question box on the left-hand side, and that will navigate as such. And then I'll answer as we go along. If I don't answer it in the presentation, I'll be following up with your emails and such. Anyway, let's get started. A lot of information to get through. I'm excited about candlesticks. I find them they're very powerful and exciting, and they're fun. So to start off, I'm assuming that most of you are new to candlesticks, but obviously those of you that are a bit more seasoned technical analysts, I find that this will be a powerful tool that you can add to your armory. They talk about synergy, using it with what they call Western indicators. So it just enhances your analysis of price charts and things like that. Okay, so here's my agenda for today. Get to it. Okay, so obviously the objective today is just to introduce candlesticks to you, just to discuss them in general, and then how to recognize these patterns, and just discuss 10 basic chart patterns, 5 bullish and 5 bearish candlestick patterns. And then some announcements regarding the webinars and traders forums going for the rest of the year and into next year. Some exciting changes happening there. Okay, so let's get started. I'm going to talk about, first of all, a bit of a historical background regarding candlesticks. As a form of technical analysis or technical charting, it's been used in Japan for more than 100 years. Obviously, it's been used to analyze the price of rice contracts. So candlesticks have been around longer than bar charts and pointing figure charts. Pointing figure charts have been around for about 400 years. There was a guy way back in 1700s, a trader by the name of Harami. That's not his picture, by the way. He was a trader that traded rice futures, and he discovered there was a link between the price and the supply-demand scenario. But he also found that markets were strongly influenced by the emotions of traders. So this is where candlesticks becomes very powerful, in the sense that once you understand the emotions that are involved in the equation, it makes a big difference to that value and price scenario. So these principles, he wrote them all down, and obviously this forms the basis of candlestick charts analysis today. The main thing is with Japanese candlesticks, it's a tool to help you measure the market emotions towards a particular share. Now this picture, this little photograph here, is a guy called Steve Nissen. He's credited as popularizing Japanese candlesticks. He brought it from Japan over to obviously the West, and he's regarded as a leading expert on the interpretation of Japanese candlesticks. I have quite a few of his books, and obviously there's a lot of information on the web on the internet regarding Steve. Okay. So that is some background information. Let's get into more of the nitty-gritties. So as I mentioned just now, you use candlesticks mainly to forecast price behavior. The idea is that these things, we talk about Japanese candlestick patterns. So these things do recur in various scenarios. And obviously using quite a few different price bars together to form a combination. So this either highlights a period of consolidation where the market's moving sideways, and the buyers and sellers waiting for information. It's like a spring, a lot of pressure, and then we react from that. So it's usually a forceful price move out of that range as such. So candlesticks help or provide a deep insight into market conditions. So you can either use it as a standalone tool, or use it with other techniques, with obviously your technical indicators like your stochastic and MACD and things like that, and as well as trend lines and support and resistance and that kind of stuff. So it becomes a very powerful formula if you use it together. The main thing is that it provides visual cues to what's happening with price. It makes just reading price action so much easier. That's what I like about candlesticks. So it's a very effective way to study the emotions of the market. And when I say emotions, I always think of psychology. We're trying to think what is the buyers and sellers thinking, what are they feeling. Okay, so this helps you interpret price much better. So there's some background to candlesticks. Okay, most of us have been using have been using bar charts for a long time. So obviously the big difference now is that candlesticks offer much more information, where bar charts looks at the high-low range. Japanese candlesticks, or candlesticks as such, looks at the relationship between the closing price and the opening price. So nothing else matters other than price. Everything else is secondary. So price action is your primary indicator, and all the other technical tools that you use would be what they say secondary. Okay. So the whole idea is that you're using this to predict reversals or continuation of a trend in the market. And that is basically one of the most difficult aspects of trading. And that is your goal as a technician or chartist, to try and determine that a change in trend or continuation of the trend. So as I say, combined with other technical tools, very useful way to determine where to get into and out of a trade or position. Okay. So some basics quickly again. Why do we read charts? Basically, here in South Africa, 90% of the market are institutions, pension funds, unit trust guys, etc. 10% is you and I, the private trader. We want to see where's big money moving the money. Okay, so this helps us to get a better grasp on the market, and also helps you to determine whether or not to risk your hard-earned trade, money on a particular trade. So this is what separates the novice trader from the professional. So obviously a lot of other factors involved, but what you're trying to do here is bring the odds in your favor. In other words, help you with a high degree of probability which direction the market will be going or share will be moving. Okay, so very similar to bar charts. We also got the high-low range, what they call OHLC charts. You've got the opening price to the left, the closing price to the right, or ticks. You get the high-low range, and you'll see on the next slide, comparing the candlestick to a bar chart, you'll find that the candlesticks are much more prettier and just much easier to look at the relationship of the opening price relative to the closing price. So it's a great visual aid. So here we go. That's what I'm talking about. So the top graph is obviously the price chart of a particular share, the bar chart. You can see the little tick to the left, and the closing price, and the high-low range. And in the bottom section, you'll see the same share, but now in the candlestick price format. So you'll see that there's obviously much more color involved now. Obviously, I've made my candlesticks more colorful. In my particular charts here, the down days are red, and the up days are white as such. You'll see once in a while these things are blue. It's the same as it's the same as the red chart. It's a down day. Okay, but that's what it looks like. We'll go into more the nitty-gritties of each little candle just now. Okay, what are the advantages of candlesticks? They're much more easier to interpret. So it's a good place for a novice trader to start figuring out chart analysis. Although I personally recommend first start a bar chart or sort of line charts, progress to bar charts, and then move on to candlesticks. I think your learning curve will be so much better if you understand the relationship with the bar chart and then looking at the candlesticks. But for the more seasoned technician, as I mentioned earlier, together with all the other Western indicators, it becomes very powerful. So your eyes adapt easily to the information on the chart. I like this. This is from one of Steve's books. He says candlesticks are very exciting. They enlighten your trading. In other words, they light your way. And that's what I feel candlesticks can do for you. Okay. What also makes candlesticks interesting is the names they have, these chart patterns. We'll talk about some of these patterns just now. We'll talk about shooting stars and abandoned babies and engulfing patterns, etc. But this helps you remember the patterns more. And as I say, what's more important is to think of the psychology or the emotions behind it. So the main thing is, the main advantage of candlesticks, it helps you identify turning points in the market. Are we going from an uptrend to a downtrend, or from a downtrend to an uptrend? Okay. So let me just see if there are any questions coming in so long. There's a question from Alistair. What is it? Just saying hello. Okay, yeah, Alistair saying how's it? No other questions yet. Okay, as I say, any questions, just type it in the box. Okay. Let's move on. I hope you guys are enjoying this. I know it's still basics, but we'll move on. Let's talk about the anatomy. What makes up a candlestick? Okay. So there are quite a few elements to a candlestick. As I say, very similar to a bar chart. You'll get the range between the high and the low. You get what they call a real body. That's the thick part in the middle of the high low range. What's important is it's obviously some of the terminology. I'm talking about a real body and we talk about the wicks and things like that. I'm going to stick to one terminology today. We talk about upper shadow. Obviously, this is the little line above the real body, and the lower shadow will be the line below the real body. Okay. So what's important, similar to, if I can bring in my little cursor here again, my spotlight. This is where it's just more visual. This is where with an open day, when it's white, it means it's an up day, because the close, this is where the market closed, is higher than the open. Okay, so that'd be a white day, which is a bullish day. When it's colored in, or it's filled in, okay, we're talking about a dark body. That'd be a down day, because the close is lower than the open. Okay. So let's just give you some of the elements. We'll go into more detail now about all these little individual tools. So let's talk about, as I say, the vertical line. Similar to the bar chart, highlights the high-low range. Obviously, the longer that line, like in bar charts, the greater the volatility. The shorter, obviously, less volatility. So we're talking about the real body just now. That's a real body right between opening and closing prices. If it's hollow or filled in, obviously different interpretations to it. If it's a filled or black body, it means that the opening price is at the top and the closing price is lower. The market closed lower than it opened. So that means there's selling pressure. So remember, a dark body is negative, it's bearish, there's more sellers than buyers. If it's a hollow or a white body, the close is higher than the open. That means there's buying pressure. When I say buying pressure, demand is exceeding supply. Okay, there's more buyers than sellers. Okay, so that's just the two main things at the moment. Obviously, the vertical line and the body and the interpretation. And that goes on to the next slide also. We talk about the color. That also just visually tell you straight away that we have an up day or down day. So that's very quickly to help you understand that. And then the length of the candle, the entire candle, from upper shadow to lower shadow, tells you the entire range of the trading day, as I mentioned earlier. The length of the body also tells you how much interest was in the share. Okay, to move the share from the open to the close, or vice versa. Okay. Sorry, not vice versa, not from close to the open. But the interest, that's what you're looking at, the length of that body. The length of the shadow, when we talk about the upper shadow and lower shadow, also suggests the tenor, the mood in the market. The long upper shadow on a short candle body, we're talking about short candles just now, it suggests that a bullish push was rejected by the traders. So obviously the sellers won in that little race. And vice versa. A long lower shadow on a short body suggests that the market pushed the price against the bullish rise, but could not force the price back. Okay. I think it's just easier to look at when you look at it visually. So let's talk about body sizes, long and shorts. As I mentioned just now, long bodies means there's strong buying or selling. So I'm referring to these two over here. Okay, whoops. Let me go back here. Sorry, wrong one. Okay, that's the long bodies we're talking about. The long body and the long body. Okay, the long body, more intense, or the interest. I think of the interest in a particular share. A short body, that's this one here and this one here, implies that there's obviously little buying or selling activity. People are waiting for more information. Remember, as we have a longer body, we have increased volatility. Okay, people panicking, get me in, you get me out. That's how I look at it. Okay, so a long white body shows strong buying pressure, and a long black body shows a strong selling pressure. Okay. Remember, when you get this presentation, by the way, just review these notes. Any questions you have, please send them through. Okay. So just go one step further. As I say, we talk about buyers and sellers, but also just think about the psychology behind it. Or is it more bullish or more bearish? There's always two groups of people in the market. There are buyers and sellers. Okay, obviously the buyers are the bulls and the sellers are the bears. Okay, there has to be a willing buyer and a willing seller to make a market. Okay, so always ask yourself this question: which group is in control of the share price right now? If the market's going up, obviously there must be more buyers than sellers. If the price is falling, there must be more sellers than buyers. Okay, so this just gives you a bit of indication. I always ask that question: who's in control? Alternatively, who's winning right now? Okay, so it's important to know when looking at the charts. And so here's a question coming through regarding the time frames. Doesn't matter what time frames you're using, be it intraday, daily, weekly, monthly, quarterly, candlesticks can be used. Obviously, the idea is that use the bigger, look at a weekly chart and then jump down to the daily chart and see if they have confirmation. That's the idea. Okay, but it doesn't matter buyers and sellers. Doesn't matter what's happening in the market and what time frame you want to see the trend. You want to take advantage of the trend. Okay, so let's talk about wide range candles with WRC. Okay, and as I say, there's a lot of interest in the share. Okay, there's a lot of volatility, and obviously prices usually tend to move in the direction of that market. Okay, so the idea is to always try and look to the left to identify the interest in the market. Okay, we start combining these chart patterns together. We'll start combining the candles together to create chart patterns to help us anticipate which way the market's going. So, as I say, that you want to know what's the interest in the share. Is it being accumulated? Remember, the institutions are the main players in the market, so they're accumulating shares over a period of time, and they also over a period of time they're also distributing. It's selling off. So that's where a bit of volume analysis comes in. Okay, so that's volume always confirms price action. So it's very important that we use volume in determining accumulation and distribution. Narrow range candles, obviously, this is where the body is smaller. It's suggesting low volatility or little interest in the share, and obviously this usually leads to reversals, either up or down. I always try and look for those kind of scenarios when the market's moving sideways, especially with narrow bodies, because basically it's going through consolidation phase, and the buyers and sellers are having a bit of a tug of war. We're waiting for new information, either bullish or bearish, and the market will break out from there. And that's where it's important to use your support and resistance levels, and that will help you to enter a trade in periods of low volatility, and obviously exit a trade in high volatility. You'll see on the next slide what I mean by that. So here's a graph of a share for a long time moving sideways, need 2 months moving sideways in a narrow range. Okay, you can see that those bodies are quite narrow, and then we have this breakout. You can also see that we may start making higher lows. If you look at the low of those higher lower shadows, you've got to look at that way. And we have this very long body the next day, so obviously increased volatility, and we had a sideways market again, and we broke out of that range again. Okay, but this is the kind of scenario I'm always looking for. Okay, and together with other technical indicators like RSI and stochastic, you want to see that we have confirmation from those secondary indicators. Okay, shadows we spoke about just now. Obviously, and I'm using the word shadows. I know some books use the word wicks, obviously referring to candlesticks as in wicks. I just like to stick to one term so you won't get confused here. Upper shadows, obviously the sessional high, the lower shadows, the session's low. Long shadows show that it's like a scenario here. Okay. Trading actually way past. Remember, that's where we opened and that's where we closed. Where we tried to go way past the open. Okay, and we pulled right back. The same thing here. So the market tried to move up, but eventually the sellers won. And same here. Okay, we try to pull the market down, and eventually the buyers won. Okay, that's the interpretation behind it. Okay, so very important to try and entertain or to try and anticipate the emotions behind the market. So people are very bearish, very bullish, but at the end of the day, the buyers won or the sellers won. There's 6 basic types of candlesticks, with long white candles, long black candles, small candlesticks, obviously small bodies. Long lower shadows, long upper shadows, and obviously one is right in the middle, like we got here, number 6. And that's basically all the different combinations you can have. And then combining them together, as I say, in combinations, creates various chart patterns, and that's where the names come from. And that's what we're going to discuss in a few slides' time. So just to help you to interpret candlesticks, I've got like an 8-step process I go through. And as I say, it's very visual. So you want to do is understand the parts of the candlestick first of all. So I look at the body and then I look at the shadows. Okay, is there a shadow? How long is the body? Is there a lower upper shadow? Is there an upper shadow? And then I start looking at the time frame. Obviously, it depends what you're using in. And this is a question that came through just now, from 2 minutes to several weeks, to several months, to several years. Candlesticks can be used in those different time frames. And also you can look at the bottom of the chart. Usually on Excel will tell you the time increments. You'll see in the graph just now that, especially on the web software, it tell you in brackets, D for daily, W for weekly, what time frame you're looking at. Okay. Then obviously you want to determine the color. If it's black, obviously it's a down day. If it's a white, it's an up day. And then on step 4, I try to anticipate where was the opening, where was the close each day, and then also the range within that day, the length of the body, obviously the volatility, and then also, as I said, the length of the body is important to me too. It shows me the interest. Yeah, it shows me the length of the shadow. It tells me the volatility. So all you want to do is put it all together. For example, in this situation, a short back candle with a long upper shadow, okay, like we have in this situation here. Prices fell over the course of the day. That's how you interpret it, because that's where we opened and that's where we closed. But the whole day we try to push the price up, but eventually we ended down. Okay, so we ended near the opening price. Okay. So let's talk about recognizing some patterns. Obviously, because of time constraints, I'm only going to handle about 5 bullish, 5 bearish. Let's see if there's more questions coming through. Hello, Peter Armstrong. Welcome aboard. A question from Peter. Okay, Peter has some technical difficulties trying to log in. Okay, that way, Peter, as I said, the presentation is being recorded, and the actual PowerPoint presentation will be sent to you guys also. Okay, so my apologies if I had technical glitches logging in. Okay, so there are many chart patterns. In one of Steve Neeson's books, he talks about 50 different chart patterns. Obviously, there's a whole lot of them. You don't have to know any one of them. There's only a few worth knowing, and that's what we're going to try and discuss today. These are the popular classic called chart patterns, and they're very useful to use. Obviously, it's understanding what's behind it, what's more important. So combining that with other forms of technical analysis, be it trend lines and support and resistance and technical tools, as I say, makes it very, very powerful. So it's also very useful to always look at a candlestick in a weekly chart and then move from there down to a daily chart. You want to see, do we have confirmation? Okay, if so, then obviously we've got a good opportunity to reverse. So here's an example of a graph. This is the daily chart of a particular share. So you'll see, okay, some down days here. We're at the top of the market. We'll go into more details just now with the different chart patterns. But we're having some down days. You can see that high is lower than this year. Although it could be making higher lows as such, making a little triangle. So it could continue breaking up. We get a look at continuation patterns. So I like to do now, switch over to a weekly chart, and you can see, okay, now we're a bit of a sideways market. And you can see a bit of this is what we call a doji, a lot of uncertainty in the market. If you had to combine this now with a stochastic indicator, we might be in overbought territory. So we've got a high probability that we might have a reversal. And that's the thinking behind it. Okay. So let's talk about some chart patterns. As I say, these are the 5 most popular candlestick patterns you can look at. These are basically reversal patterns that show you after a pullback. So this is when the market has fallen already. That's what we call a pullback, when the market has retraced. These are the patterns that you might see at the bottom of a trend. Okay, so we'll go through each one of these individually and talk about them into more detail. Okay, so let's talk about bullish engulfing. And by the way, the Wind software in the highlighter module, you can actually scan the market looking for these chart patterns. So a very useful time saver. I know I use another program called Metastock, a big American program. It's got an expert advisor. You can load up your candlestick charts, and then from there you just push a button and they'll highlight the different chart patterns for you, or label them for you, and then from there you can do a further analysis. So there's various tools you can use out there. Anyway, let's talk about the bullish engulfing pattern. First of all, it consists of 2 candles. On the first day, this is the first day here, we have a narrow range candle. Okay, that's where we opened and that's where we closed. So we have a down day on the first day. On the second day, okay, the wide range candle, okay, that's where we opened. So we opened lower than the previous day's close, but then she closed up higher than the previous day's high for the day. But basically also what we do is we engulf, or we cover the previous day's candle. Okay. Or it is that the sellers at this point in time were in control, and now the buyers are taking over. That's sort of the interpretation behind it. And ideally you want to see that you want to see volume increasing. So you bring in your volume histogram, and you want to see that the buyers are getting in. Okay. So just think of it engulfing or covering or overwhelming. Okay, we're overwhelming the sellers. Okay, the buyers are taking control. So demand is exceeding supply. And obviously this is where we have a change in trend, and hopefully the share price runs up from here. Okay. By the way, this is from a lot of websites out there. This is one of my favorite websites called swingtradesstocks.com. There are many other websites, and there's a wealth of information out there. So this is just hopefully whetting your appetite today regarding candlesticks. Okay. Let's talk about a bullish hammer pattern. And the best way to always think about this is that the hammer pattern hammers out a bottom. So when you see this thing, it looks like a lollipop. Okay, imagine there's my little lollipop. But the Japanese candlestick terms, we call this a hammer. Okay, so the share opens. That's where it opens. Okay, at some point the sellers try and take control and push the price down. Okay, and then by the end of the day, the market pushes up again, so the buyers take control, and we close up higher. Okay, so usually this happens at the bottom of the market when a whole lot of stop losses have been hit, and this is where the clever money starts getting in again. Okay, so remember, always think of a hammer hammering out the bottom of the market. Okay, very powerful indicator I like to look for. Then we have a Harami. Now, Harami is the term there. The Japanese term means pregnant. So the previous day, the first day, this is the mommy. Okay, that would be the mother. And the short body or the small body the next day, when it's within that range, is the baby. Okay, so as long as the real body is within the previous day's range, this we start calling this a Harami. What is that? Remember, that's where we opened and that's where we closed. Now we have a higher open. Okay, where higher close, that means the momentum is slowed down and it's reversing. Okay, just don't get confused with the Harami compared to a bullish engulfing, like the other way around. Okay, so don't get confused about it. Just think about the mommy and the babies in front. Okay, let's move on to the bullish piercing. This is one of my favorite indicators also, together with the bullish engulfing. Also 2 candlestick pattern. On the first day, we have this very long range. A candle, that's where we opened, that's where we closed. Okay, short little wicks on each side or short little shadows. Okay, so it's the sellers are in control. That's what we're talking about here. Next day, we have a wide ranging candle. We opened lower than our previous day's close. Okay, eventually during the day we try to push up higher, and we closed up higher. We closed up more than halfway of the previous day's real body. So we pierced into the second day's move. Okay, so it's a very, very powerful reversal chart pattern. So they call it piercing pattern. Okay, then we have dojis. Now, a lot of people always talk about dojis, and they are very, very popular. Basically, what dojis represent is indecision in the market. And compared to a normal bar chart, they're very, very similar. Obviously, together with other candlestick patterns, very, very powerful. So it basically brings the question of a change in trend. So the share opens up and then obviously goes nowhere during the day and closes at or near opening price. So it looks like a star, okay, a little cross. So it usually highlights a possible a change in trend very soon. There are quite a few different kinds of dojis. This is one of the most powerful ones, what they call the long-legged. This is a long-legged doji. obviously high-low range. And as I say, that's when the market opened and it closed at the same price. Okay. So there's a lot of indecision here. The buyers try to push the market up and the sellers also try to push the market down. We close right in the middle, so there's a lot of indecision. Okay. Dragon, Doji, obviously at the top of the market, it will be bearish. At the bottom of the market, it will be bullish. Okay. So you've got this high-low range also, and the buyers and sellers up in the same price. The sellers try to push the market down, and eventually we ended up at the same price. Okay. At the opening price. So remember, you see this pattern at the bottom of a trend, very bullish. Obviously, at the top of the trend, it can be bearish. This is a better pattern to look at the top of the trend. More powerful because obviously we're closing at the low of the range. Okay. So those are some bullish candlestick patterns. Let's look at some bearish. Obviously, this is the opposite now. And obviously this comes after a rally. So after the market has run up, okay, you start seeing these patterns that start happening and confirming a change in trend that the market is moving down. So we've got what they call bearish engulfing. We talk about shooting star. If you look at it as an inverted hammer, we have a Harami, and we have dark cloud cover. Remember on the bullish side, we have what they call a bullish piercing. This is where the nice little names come in, dark cloud cover. And obviously Doji patterns will apply also. Okay, so let's talk about a bullish engulfing. Okay, we've got a real black or dark one. Remember, if a bullish one would be a white one, covering a black one. That means at the end of the trend. So here's the top of the market. We're still bullish at this point in time. Okay, but the next day, remember that's where we closed. The next day, we open higher. That's where we opened. So we gap up, we try and push the market a bit higher, eventually the sellers start taking over and we close right at the bottom. But we engulf or cover, or overwhelm the buyers. So the sellers are in control. We start seeing this happening on increased volumes. It means there's panic selling and obviously the guys want to get out of the market. Okay. So the momentum is shifting from the bulls to the bears. That's the psychology behind it. Shooting star. Okay, again, it's a two-candle chart pattern. So yeah, this is where we closed the previous day. We gap up. Okay, that's where we opened. We try to push the market a bit higher during the day. Eventually, the sellers start taking over, and we push the market lower, and that's where we close. But there's a gap. Okay, so this thing it's nearly the same as a inverted hammer. It's got a very small little wick. Doesn't really matter as long as it's quite small or insignificant. Doesn't really matter. But basically, the sellers are taking over control. Okay, there are more sellers than buyers, and they anticipate a change in trend coming in the back. Okay, this is a bearish Harami. Okay, this is the small real body. Okay, in this situation, remember this is the top of the market, so that's where we opened. This is where we closed the previous day. The next day, we open lower. Okay, we close lower, but this is the mother, okay, and this is the baby. Okay, so it's a reversal pattern highlighting a possible change in trend. So it's one of the most popular ones when the colors are different. Okay, it's more reliable. I like to have it more reliable. Remember, at the top of the market, this should be the buyers are still in control, and the sellers are taking over the market. Okay. The dark cloud cover, as I say, very powerful compared, similar to your piercing. This is what they call dark cloud cover. Again, very powerful reversal pattern. Appears near the top of a trend. We have this white candle, so this is where we open, that's where we close. We try to push higher, and obviously during the day also that we try to push lower, but the buyers won in this situation because we closed near the top. Okay. Next day the market opens higher. That's where we opened. That's where we closed. Okay, but we pierced. We pulled right back past midway or midpoint of the previous day's real body. So we're pulling back. So the buyers are starting to take, the sellers are starting to take control. Okay. So a very, very powerful chart, and obviously together with other, as I say, stochastic in that, and you see it, we're in overbought territory. You get a higher probability of a change in trend. Okay. And then, as I mentioned just now, Doji's top of the market, very similar. Remember, the main thing about Doji is it's highlighting indecision. Okay, lots of indecision in the market. And together with other little chart patterns, just adds more influence, and obviously makes it more powerful. Okay. Here's another question coming through. Will there be more advanced candlesticks in later webinars? Yes, obviously next year. But you guys will send me an email. You'll see my details just now. What specifically you want, more advanced technical analysis. Obviously, most people are still novices to intermediate. So we're talking about advanced candlesticks. What specific? Yeah, we're talking about combining moving averages now with a breakout above a resistance trend line, and with a RSI, sorry, this is a stochastic indicator. This is the kind of thing that what I call advanced technical analysis. You have to make it more complicated than this. Just bends the odds in your favor. So yeah, we have this sideways market. We need to break above resistance. There, the close above resistance. That would be your entry point, and we were quite close to oversold territory. So that would be the nice entry level at that point there. At this point in time now, you can see we're just above that, what is this, a 10-day moving average, bit of a sideways market. So you can see that this little bar is engulfing the previous day. Ideal situation, it should still be a bullish day, but you can see it's engulfing. But we also overbought, so you've got a high probability that either we're going to bounce off this moving average, or we're going to pull right back. So you can draw in trend lines here and use that as a trigger, a change in trend. But combining this with your chart patterns, as I say, it just increases the high probability. So I hope that answers your question, Gerard. Okay. What other questions are coming through? No sound. Yeah, there's the question here. I don't know how to pronounce your name, Moyoba. Can you use candlesticks for trading shares as well as currencies? Yes, you can use, remember it's a price chart, like your line chart or bar chart. You can use it on any security. When I say security, it's a generic term for shares, warrants, futures, you name it, currencies. So yeah, same principles apply. Any other questions? There's a question from Steve. Great question, Steve. Where do you draw the trend lines? There's two schools of thought. I personally like to use the extreme ranges. So I would be connecting all the lows together, the lower wicks, the lower shadows, and also the upper shadows. That's one way of looking at it. Alternatively, connecting the real bodies. I like to use the bar charts or the candlesticks for the extreme ranges, and then use the line charts, and then use that for connecting closed lines also. Okay. So there's two ways. I would suggest experiment, and you decide which is better for you. Okay. The question here from James Whitelaw. Nice webinar. Enjoying how you tie it all together with moving averages, overbought, oversold. Yeah. Okay. So the idea is that, yeah, thanks James for that input. The idea is to remember, technical analysis, bottom line, is a probability tool. So if you can tie this up with other technical indicators, obviously you bend the odds in your favor. And that's what you're trying to do here. Okay. So James, thanks for that comment. Okay. So guys, I've got a lot of information from these two books. These are books I've got at home. I use a website called Traders Library. They obviously just focused on trading and investment books and things like that, financial books. Obviously you can use Kalahari, or you can use Google. I always use Traders Library. They have a lot of specials quite often, and I like what I like about it also. They've got a facility where you can build up an online library. So I buy books, ebooks, and wherever I am in the world, I have access to these ebooks, and they're very powerful. And obviously there are a lot of websites out there. You just go Google candlesticks or candlestick patterns, and you'll pick up a wealth of information. These are the two books I've had for many, many years. Obviously, books like this are expensive. They're like, oh, geez, $500, $50 to $60 a book. So you're talking about $500-600 a book. Very worthwhile. This is a book I recently got. It came with a pack of 4 DVDs. So this by itself was a course, and this is what made it powerful. Steve Nielsen just knows how to simplify things. So both these are Steve Nielsen's books. This was one of the very first ones he ever wrote, Japanese Candlestick Techniques. And obviously this is one of these more later ones. And there are a lot of YouTube videos on Steve Nielsen also talking about candlesticks. Okay. So guys, quickly a quick summary before we handle any more questions on that. Candlesticks, as I say, advantages, they're very easy to interpret, they're very easy to use, so they're very visual. So yes, it does take some time to get used to them, but don't get hung up so much on the names. Just want to stress, try and interpret the emotions behind it. Who's winning the war between the buyers and sellers, and combine that now with volume. Remember, volume leads price action. So you want to see increased volumes and things like that to confirm a buying pressure and obviously selling pressure on the other side of the coin. Remember, these things candlesticks are great to identify turning points in the market. So I always say hindsight's a perfect science. That's where it's great. This is how you learn about technical analysis. I know in the web software you can go back in time, load up a Japanese candlestick chart, and then cut off the data and say, okay, this was today. What will happen tomorrow? And you can move forward one day at a time or a week at a time. And this is how you learn. It's what I call my technical analysis simulator. Okay. So just to simplify it for you, remember those 8 steps. Understand the parts. Okay. The upper and lower shadows, the real body, the time frames easy to understand, and obviously the color. Okay. To go up or down, and obviously the relationship between the opening price and the closing price. From one day, and obviously the closing price compared to the previous day. It's also very important to understand that. The range, remember the volatility, also tells you a lot. And obviously the length of the body. Remember short or narrow bodies, there's a lot of activity happening, or not a lot of interest, whereas a large body, obviously a lot more interest and with increased volatility. Okay. And then obviously put it together and just say, okay, with my stochastic and all my other technical indicators, I anticipate the price to move up or down. That's what you're trying to do. Okay. So guys, I hope you've enjoyed it. That was a very, I know some of you are novices, some of you have been worried about the content of this will be over your head. Hopefully I've made it simple enough for you to understand. We will be having more advanced webinars in the future on candlesticks. So talking about that, by the way, we've got our last 2 traders forums for the year. And by the way, you guys are at Joburg and you guys in Cape Town, you're in for a treat. We are changing the format slightly, where it's going from, we're moving from a scenario where it's 2 hours, going to 60 to 90 minutes. And I could try and vary it, the content as such. But the main idea, I'm changing it over to call it a cheese and wine afterwards. We're having snacks and drinks. Yes, believe it or not, that PSG is actually going to give you guys something back. So the opportunity is obviously to network with other fellow traders or investors. A lot of times we don't have time to do this. We just come along, we list it, and we run away. The idea is that you could also meet some of the traders or dealers from PSG itself. And you can have this situation where you can ask me questions. But it's more social, and we're going to be doing this format going into next year. And those of you in places like Bloemfontein and Nelspruit and Polokwane, I've never been to for Traders Forum, guess what? We are coming next year, and we'll be using the same format. So just watch the events calendar soon. We'll have all those dates up for next year soon. Okay, so in 2 weeks' time, I've got my last one here for Joburg. We are moving the venue to still be here in the campus. I'm just moving up to the forum, to the conference center, where we can have some banqueting facilities. In Cape Town, we're still holding it at the Garden Court in Walmer Estate. Again, we'll have some cheese and wine and opportunity to socialize afterwards. So let's talk about our last 2 webinars for the year, for this year. end of the month, we got a webinar on talking investment strategies. So we're going to talk about value and growth and investing for income. So that'll be on Wednesday, the 27th of November. Those of you that are a bit more of a long-term investor, this might help you with your strategy as an investor. And then the last one for the year, together with candlesticks, point and figure charts is also my favorite. This I call it the forgotten art of point and figure charts. And they've been around for about 400 years. There's all noughts and crosses. Also quite a few different chart patterns you use, but I use it mainly for price projection to help you determine where the price will go to, and it's very, very powerful. But like this webinar, we are limiting these things to the first 100. I know that we had oversubscribed on this, and we had quite a lot of interest in our candlesticks, so hopefully our last two will be the same. Okay. So guys, I've been talking about WEN in between. Those of you that haven't got any technical analysis software, maybe consider our WEN. The software is free, or you just subscribe to the download service. So the software has all the traditional indicators, especially the candlesticks, obviously moving averages, etc. But the idea is that whatever you're using is to play around with candlesticks, to familiarize yourself with some of those chart patterns. Look for those bullish engulfing and piercing lines and those dojis, and they'll start picking and they start jumping out to you, and you interpret them much better for you. So this presentation and recording will be emailed to you guys soon. And if I can just ask you guys again, please, any comments you have regarding the webinars, you can just go to our Facebook page, PSG's Facebook page, just to try and get a community going. And let's talk about technical analysis so everybody can learn from it. Because of time constraints, I couldn't really go into any trade ideas, but those of you that are existing CFD and single stock futures traders with PSG Online, we have a daily we send out called the Stockbroker, where we use these candlesticks together with all the other technical indicators and money management tools. So it'll be a great tool to help you make a decision or help you complement your own analysis as such. So just remember the Traders Forum. There's a new format coming up. But you guys must also tell me, what do you want to discuss in those formats? You know, in the past, we always use these Traders Forums as an information session. So what I'm going to do is talk about more shares in general, what's happening throughout the year. By the way, from now on, from next year, we'll be having 2 Traders Forums a month. One in Joburg every month, one in Pretoria every month, and then from there around the country. Okay. So our next 2 webinars, as I say, we're discussing investment strategies and obviously the forgotten art of point and figure charts. Okay, let me see, are there any more questions that come out? Okay. There's a question from Andrew. Looking forward to the next one. Great, Andrew. I hope you enjoyed it. Any other questions? I've got a question from Marcel. So yeah, let's keep you guys waiting. Okay, another question from Marcel. It's been his 4th webinar. Great. Okay, we're getting guys hooked into this. Okay. Sorry, I'm just trying to read the investment seminar. Okay, he's looking forward to the investment seminar, or I'm looking for the next one. Okay, here's a question, okay, it's off the topic from Alvain regarding Make a Million. No, unfortunately, Make a Million won't be happening this year. It's a bit late in the year anyway. But Make a Million, the JSC is not going to be our sponsor anymore, and they've dropped it. Remember, they were co-sponsored to the Make a Million all the time. And obviously the whole idea was to drive education together with the JSC. So unfortunately, no Make a Million this year. I don't know about next year either. Okay. But guys, there's a question. Okay, Elizabeth, thanks. I appreciate it. Thanks for your compliment. Okay, here's another one from Arun. Thanks for simplifying a complex topic. Great. I hope it was simplified enough for you guys. What is data share? This is a question from Stephen. Data share is a subscription service or download service to our web software. So as I say, the software is for free. You're paying for the information, Stephen. JSC is control of JSC prices. So obviously that's where we pay a lot of that too. It's only 169 Rand per month. It's end-of-day data to keep your technical analysis or charting package up to date. So you can do it manually, obviously very time-consuming. You won't be able to track all 4 other shares in the market. That's when you're talking about indices and all the other commodities and things like that. So to answer your question quickly, Doji shares is a download subscription service. Okay. Here's a question from Michelle. Some examples. Yeah, Michelle, just because of time constraints, I don't want to go into too much detail. But if you email me a question, I can maybe send me the graphs, the charts that you're interested in, and we can look at it from a candlestick point of view. Here's a question from Gus. Hi, Gus. How do you subscribe to the stockbroker? Great question, Gus. Thanks a lot for reminding me. So if you're existing CFD or a single stock futures client with PST Online, just send me an email. By the way, here's my let's get rid of this quickly. There's my email, my contact details. There's my contact details, seanvdb@psg.co.za. So send me an email saying that you want to subscribe or get the stockbroker. I try and get that report out by 8:30 in the morning before the market opens. Very short. I try to highlight some trade ideas. I talk about what's happening in the market and anything that can affect the market that day. And then obviously intraday, anything happens on any of those trade ideas, if I remember, I always try and send out the update, be it a stop loss has been triggered or a trade spotlight has come onto the radar. Okay. So guys, from my side, I hope you've enjoyed this presentation. As I say, this presentation will be sent to you guys the next day or so, together with the recording. And please, if I can give you a word of advice, go review it, reinforce the information that you've learned now. Some of you, it's the first time you've been exposed to candlesticks. It might be way over your head. The more you get exposed to the terminology, the easier it becomes. Okay. But thank you very much. Thanks for your participation. Thanks for your support. And we look forward to the next webinar. Enjoy the rest of your day. Bye-bye.